So, have you ever seen a stock that just looks like it's an absolute rocket ship? I mean, a surefire bet? Well, today we're digging into MFI, a company whose stock has posted some truly mind-blowing gains. But, and this is a big but, what if all that incredible upward momentum is actually a giant red flag? Let's get into it.
Okay, to really get how wild this ride has been, you just need to look at these two numbers. Back in early July, a single share of MFH would have cost you about $4.25. Fast forward just 3 months to October, that same share is now worth over $29. That is not just growth, my friends, that is an absolute explosion. And right here, this is the mystery we're trying to solve today. Because despite that jaw-dropping performance, the technical analysis, the system, is flashing a clear sell signal. So what is going on? Why is the data screaming danger when all you can see is a rocket heading for the moon?
To figure out that sell signal, first, you gotta understand the buy case. We need to look at all the positive signs, everything that's been fueling this incredible run. Because, on the surface, the view from up here looks fantastic. So, one of the key tools for this is something called moving averages. Here's a simple way to think about it. The daily price of a stock is like a bumpy road, right? Lots of little ups and downs. The moving average is like the suspension on a luxury car. It smooths out all those bumps so you can feel the real underlying momentum, the actual direction you're headed. And for MFH, wow, the signals couldn't be clearer. Every single moving average, we're talking short-term, medium-term, even the long-term 200-day, is pointing straight up. And the current price, it's soaring way above all of them. This is the textbook definition of powerful, broad-based momentum. It's all systems go. But this is where our story takes a turn. Despite that beautiful, powerful trend, if you look a little closer at the technical dashboard, you start to see these bright red warning lights blinking. Houston, we might have a problem. Now, this condition actually has a name. It's called overbought. And the absolute best way to think about it is to picture a rubber band. The further and further you stretch it, the more tension builds up, right? Sure, it might stretch a little more, but the risk of it snapping back hard gets higher and higher with every little bit of stretch. The first big warning light is the Relative Strength Index, or RSI. It basically measures the speed and change of price movements. Anything over a score of 70 is considered the danger zone, and MFH is sitting at 78.5. That rubber band we just talked about? Yeah, it is stretched incredibly tight. And check this out. Here's another red flag, this time from Bollinger Bands. Think of these bands as a kind of statistical tunnel, where a stock's price is supposed to stay most of the time. But MFH's price hasn't just touched the top of the tunnel, it has broken clean through it. It's officially in extreme territory, and that often happens right before a price pulls back. And this isn't some isolated warning. Other indicators are basically screaming the same thing. The Williams %R, for example, a score above -20 is a warning sign. MFH is at -3.8. It's just more and more evidence that this stock is stretched way, way out to its absolute limit. So what do we have? We have two completely opposite stories happening at the same time. One story says full speed ahead, the other says danger, cliff edge approaching. So how on earth do you make sense of this? Well, it's all about reading the entire dashboard at once, not just the one gauge you like. And this chart really lays out the core conflict, doesn't it? On one hand, the trend strength is undeniably high. It's off the charts. But on the other hand, the overbought risk, all those warning lights, they're also flashing at maximum intensity. Both of these things are true at the exact same time. And there's one more thing that's just pouring gasoline on this whole fire, making the potential rewards and the potential risks even bigger. And that one thing is volatility. This stock isn't just climbing a gentle hill, it's swinging wildly back and forth. And here's what that volatility actually looks like in dollars and cents. The stock's average true range is over $3. That means on any given day, this thing could potentially swing all the way up near $33 or drop down to $26. This is not a gentle ride, folks. It's a full-on roller coaster. So when you put it all together, the powerful trend, the screaming overbought warnings, and the crazy high volatility, where does this thing go from here? Well, the analysis really points to three main possibilities. So here's how this might play out. Scenario 1, the bullish case. Pure momentum wins and the stock just keeps climbing.
Scenario 2, the bearish case. That stretched rubber band we talked about finally snaps back, and we see a sharp pullback as people take their profits. And then there's the third, neutral scenario, where the stock just kind of trades sideways for a while as the market tries to figure out what to do next.
And this really brings us to the final conclusion from the analysis. Now notice it doesn't say the stock is going to crash. It says warrant caution. What that really means is that with everything we've seen, jumping in right now at this super high level is a much, much riskier bet than it was a month ago. The risk-reward balance has shifted. And really, all of this just leads us back to the one crucial question you have to ask for any stock that's flying this high. When does a powerful, beautiful trend become a dangerous trap? Well, the answer lies in learning how to read the entire dashboard and not just staring at the speedometer.